Hello, this is the chapter 4 synopsis. In this chapter, we're going to be skipping the first part of the chapter, which is on financial planning, because if you're interested in more in financial planning, you can take a course at Nichols. One of our electives is Finance 470, which is personal financial planning that you can take. So that's not covered in this class. So the main thing to focus on for this chapter is the efficient markets, the section on efficient markets, efficient market hypothesis, and also Roth IRAs, Roth versus traditional IRAs. So when you're studying for the quiz, focus on those three areas. Know the difference between a traditional versus a Roth IRA, efficient market hypothesis, what that is, and the different types of market efficiency. But before we get into that, I just wanted to touch briefly on capital gains. So as we mentioned in chapter 1, if you buy a stock for one price and sell it at a higher price, you've got a capital gain. Well, this is the way that these capital gains are differentiated, and I'm going to show you or tell you how you can minimize your tax liability on these capital gains. So a short-term capital gain is if you've bought and sold a stock in less than 1 year. And that is taxed at your regular tax rate. So whatever your tax rate is on your income, your earned income, that's what the short-term tax rate is, capital gains tax rate is. If you own a stock longer than a year, couldn't be 1 day longer, but any one or as many days longer than a year. After a year, it's a long-term capital gain, and that's a lower tax bracket. That's a lower tax rate. So just remember, short-term capital gains taxed at your regular tax rate for earned income, and then long-term capital gains are taxed at the lower long-term capital gains rate, which they change it now and again. They were lower during the Bush and Trump administration. Now Biden is talking about raising the capital gains rate, but not really not significantly. And the capital gains rate is going to be raised on people with significant amount of wealth. It's not going to affect most people if it stays the way they're talking now, which is summer 2021. Okay, so now, if I were thinking of selling a stock, if I thought a stock was going to go down and I thought I should sell the stock, I would not sell it because of tax reasons. So, I try to hold things long term, but if I had a stock that I hadn't known for very long and I thought it was going to go down, I'm not going to worry about the taxes. I'm going to go ahead and sell it. So that taxes are consideration, but shouldn't be your main consideration. Okay, so you get to the end of the year, and let's say that you're looking at your capital gains, and let's say you have quite a few capital gains. Well, you don't want to pay taxes on them. You can offset your capital gains with capital losses. So if we what they mean by paper profits is unrealized capital gains. Let me backtrack for a second. So if you you don't have to pay any taxes, you don't have a capital gain until it's realized, until you sell it. It's just paper profits until you sell it. And that's what they mean by that. Okay, so you can offset your capital gains. Here's how you do this. Let's say it's December and you're looking and you have say $10,000 in capital gains. Well, you can sell some of your losers and offset some of that money. So to make it easier, let me reduce that down. Let's say you have $1,000 in capital gains. So you can offset short-term capital gains with short-term capital losses, long-term capital gains with long-term capital losses. So to make it easy, let's just consider it long-term. So you've got $1,000 in long-term capital gains. So I'm going to go through my portfolio and I'm going to see if I have any losers on paper. So maybe I've probably lost money on a few stocks. We all have winners and losers. So let's just say ExxonMobil. Oil's been down for a long time. So let's say I've got a loss in ExxonMobil. So I'm going to sell ExxonMobil. So let's say I have, just for the sake of argument, I have $1,000 loss that I can take in ExxonMobil. I sell ExxonMobil. I've got $1,000 loss to offset my capital gain of $1,000. I just got rid of my whole tax liability. So you can sell your losers at the end of the year or whenever to offset any capital gains that you have to eliminate the taxes. Now you're also allowed to take up to $3,000 in capital losses per year. You can deduct that on your taxes. So let's say I had, just for the sake of argument, let's say I had a $4,000 loss in some oil companies. So I sell all the oil companies. I've got take my $4,000 loss. I've got $1,000 capital gain. My net is negative $3,000. That's the most I can take in a capital loss in 1 year. And so I go ahead and take that. Now you might be asking yourself, well, what if you have more than 3,000 in losses? Well, if you do, you can carry those forward. So there's people out there with substantial capital losses. Since you can only deduct $3,000 a year, think about people who had losses back in 2007 to 2009 when the market was down so much. They can carry those forward and just take that additional $3,000 every year that they have in capital losses from prior years. And they can also use any losses that they have from former years that they haven't taken from prior years to offset any capital gains in the current year. So if you're carrying, some people might have $10, $20, $30,000 in capital losses on the books, so to speak. You can use that to offset any future capital gains. So you might be thinking, let me talk about this wash sale now. So you might be thinking, well, if Dr. Lawrence just said to sell ExxonMobil she's going to sell ExxonMobil to take a loss on it. But that's a good company. That's probably going to go up. So why didn't I just sell it and then take the loss and then the next day buy it back? Well, that's called a wash sale and they disallow that. They'll disallow your capital loss if you do that. The IRS will. So in other words, if you sell a stock and take the capital loss, you can't take the capital gain, you can't buy it back for 30 days. But here's how you get around that. So let's say I still want to be in oil or be in energy because I know energy is going up. I had to sell ExxonMobil because I wanted to take the capital loss. So I just turn around and buy Chevron or Murphy Oil or BP. You can just buy another stock within that industry, or you can buy an oil exchange traded fund. So what I'm getting at is it's really not a problem if you have to wait 30 days to buy that stock back, because when I sell a stock to take a capital loss, I just immediately, if I think it's going to turn around, I just immediately buy one of the competitors. Okay, so that's just a short lecture on capital gains and capital losses and how you cannot pay any taxes on your capital gains. Okay, pension plans. We're not going to cover this either. Other than to say, I just want to explain briefly what it is. A defined benefit plan is, we're not going to cover it in detail, but I do want you to know just the basic definitions. Defined benefit plan is like an old-fashioned pension plan that you get when you work for a company. You get this pension plan for the rest of your life when you retire, and it's based on a formula. It's usually your average annual income or at the company multiplied by a multiplier like 2%. Typically it's about 2% times the number of years of service. And so that's how they get to the annual benefit that you're going to get, and then they pay it out monthly. With the defined benefit plans, these are kind of going by the wayside because all of the risk is on the employer. They're the ones who have saved the money over the years and invested the money to pay you this benefit, to pay you your pension. So they've switched. A lot of these have gotten into, they're underfunded. They've gotten into financial trouble. They call it underfunded because they haven't gotten the investment returns on the contributions that they thought they could get, and people are living longer, and so that's been a problem for them. So don't even count on having one of these plans, which is not a big deal because you're better off with a defined contribution plan. A defined contribution plan is what we call, one of them, the most common one is a 401k plan. That's where you put money in to a plan, and your employer may or may not make contributions. Typically they do. So your retirement plan when you retire is whatever your account balance is, and in that plan. So you're in this plan, and you can pick various mutual funds and figure out what your risk tolerance is, and the risk is on you. The onus is on you to make the right investment choices, and so the money will grow. And so, as I said, then when you retire, you just annuitize it. Your benefit is whatever that account balance is, and then you just start taking contributions, taking distributions from it. So that's what makes this class so important. This and the financial planning class, Finance 470, if you end up taking that elective. You're the one who's going to be making these decisions. You're going to have to pick your investments among these different mutual funds. And so that's one of the big issues in retirement planning today, is a lot of people, the majority of people, just don't understand, and they don't know how to pick investments. And they think, oh, well, it's a retirement plan, it should be safe, let me just put it in cash, which is the dumbest thing you can do because you won't even be keeping up with inflation. Retirement plans, remember, long-term investments, so you want to be in the stock market. So anyway, those are the basic types of pension plans. Now, the other thing I wanted to talk about regarding investing in retirement is IRAs. So you have two types of IRAs. An IRA is an individual retirement plan. So if you have earned income, you can open up an IRA. So now this traditional IRA, the way this works is you put money into an account that's categorized as an IRA. So let me explain. First of all, a lot of you are probably thinking, well, what and where is an IRA? What is it, and where would I open up an IRA? Well, it's not like you go to the bank and open up this IRA and you're putting money in and it's in a savings account. You can open up an IRA at any brokerage account, Ameritrade, E-Trade, Scottrade. You could go to Raymond. You could go to Edward Jones if you wanted to pay Edward Jones to manage it for you. As an example, you can open up an account with Schwab or Fidelity, and the account is just titled IRA. Then you make your contributions. You can put the money in anything you want to. You can put it in mutual funds, you can put it in individual stocks, bonds, anything. Okay, so with the traditional IRA, you can contribute a certain amount per year. For 2021, it's $6,000. If you're over 50 or 50 or over, you can contribute up to $7,000 a year. So let's just say you've contributed $6,000. Well, let's say you open up an IRA. Let's say you have a part-time job. You're making, $10,000, $15,000 a year, whatever. And let's say you contribute $100 a month. You're going to contribute $1,200 a year into this IRA. So at the end of the year, when you do your taxes, you can deduct this $1,200 off of your tax return, off of your income. So with a traditional IRA, you put money in, you get a tax break every year on your contributions, and then when you retire and you can at 59.5, you can start taking the money out. You have to take it out by 70.5. So whenever you retire and start taking the money out, that's when you pay taxes on the money. You see, so you put money in, you get a tax deduction, and then when you take money out, that's when you pay taxes. So the idea being, when you're retired, you're going to be in a lower tax bracket, and you'll be paying less taxes. When you're working, you're in a higher tax bracket, and you need the deduction. So that's a traditional IRA. Now, you see here, if you if you're if you have a pension plan through work, you can't take you can't take the deduction. So this doesn't work for people who have a pension plan through work. I wouldn't even recommend a traditional IRA for you all, because you're young. There's a better type of IRA that's been around since like 1997, and that is called a Roth IRA. So let's talk about Roth IRAs. Well, maybe it's not on, there it is. Okay, so let's talk about a Roth IRA. This is a much better deal. The Roth IRA, anyone can contribute to a Roth IRA. Anyone who has earned income. Doesn't matter if you have a retirement plan with your employer or not. As long as you don't make a certain amount of money, and it's in the high 100,000s. It changes every year. But if you make, I think it's around 160,000 or something, 150 to 160 if you're single, 190 or something if you're married. So you have to be making a substantial amount of income to not be able to contribute to a Roth IRA. And before you do that, if you're in that window, you can just do a quick internet search and see what the current limitations are. But anyway, with a non-deductible Roth IRA, it's called non-deductible because you don't get a tax deduction. But here's the beauty of it. You put the money in, you don't get a tax deduction. However, your earnings are not taxed. When you take the contribution, when you take the money out when you retire, you're not taxed. So you're never going to be taxed on this money. This is the beauty of it. So think about this. If you're 20 years old and you're contributing $120 a month into a Roth IRA, $1,200 a year, and you can earn around 10%, you're a millionaire by the time you're 65. That's $1 million tax-free that you'll never have to pay taxes on. And this is, so just to repeat, Roth IRA, you put money in up to $6,000 a year. This year, it's going to go up as the years go on. You don't get a tax deduction, but because you put it in with after-tax dollars, you don't have to pay any taxes on your earnings, and you don't have to pay taxes when you withdraw. You also don't have to take withdrawals if you don't want to. So let's say you turn 70, and at age 59 and a half, you can begin taking withdrawals if you want to, but if you don't want to, it's no problem. At age 70, with the traditional IRA, where they make you take withdrawals, with the Roth IRA, you don't have to take withdrawals. If you have other sources of income, other sources of money, you can just let this ride for your family. So it's a really good deal. This is the other thing that I really like about the Roth IRA, especially for people your age. It's not like this money can never be touched. Let's think of it as an emergency fund. Let's say you start putting money into a Roth, and then down the road, you need money for a car, you need money for education, you need money for a down payment on a house, whatever. You can take the contributions out whenever you want to, with no penalty at all. So let's say you've been putting money in and you need a few $1,000s. You can take a distribution and you're not going to be penalized on that. You're allowed to do that because it was after tax money. Also, the earnings, once the earnings have been in there for 5 years, you can take the earnings out without a penalty for certain reasons. First time home buyer up to 10,000, education expenses, medical expenses, or the threat of bankruptcy. Now, I don't recommend taking money out, but you can. It's nice to know that you can if need be. So anyway, make sure that you understand and can discuss the difference between a traditional and a Roth IRA and what the components of each one are. All right. Okay, efficient market hypothesis. So in chapter 1, we mentioned that the markets are efficient. And the reason we say that is because you can't expect to consistently beat the market. We might, as an investor, you might beat the market, a few months, or every now and again you might beat the market, but realistically, in general, people cannot consistently beat the market. And so and basically that's what we mean when we say that the markets are efficient. So then one of the reasons that the markets are efficient is that there's a large number of competing people. There's all this information that's out there. It's easy to get in and out, and unless you have inside information, you're not going to be able to outperform the market on a consistent basis. So let's I'm looking for an efficient market hypothesis. Let's hang on a second. Okay, so there's this efficient market hypothesis that says that the markets are efficient. There's three forms of efficient market hypothesis: the weak form, the semi-strong form, and the strong form. Make sure you read this in the book before you take the quiz. So, because there are a few questions on this. So the weak form basically says that all historical information is priced into the market. So in other words, I can't say, well, last week or a month ago, a company had a good earnings report, and so I'm going to invest in that company because I think the stock's going to go up. It's already happened. So what they're saying is that all past information is already reflected in the stock price. So you can't use past information to try to make abnormal returns. So the market is efficient in the weak form. The market does reflect all historical information. Now, the semi-strong form includes the historical information, but it adds publicly available information. So with the semi-strong form of efficiency, they're saying that all publicly available information is included in the stock price. So as soon as it becomes public, the price will adjust. So any earnings reports, any news, any publicly available information is going to be reflected in the stock price. So you cannot, and we have shown, and studies have shown that that's true. Now, sometimes the markets will overreact in positive or a negative sense to positive or negative news, but it is reflected. So if you hear something in the news, or if a company has a report, you could run to your computer, or you could be sitting by your computer and buy something right away. You might be, you might be able to make a little bit of money before other people hear about it, but overall, in the long run, you can't do that. But what they're saying is that news is pretty much reflected immediately in the stock price. And one thing that's interesting is that when you look at a stock, or when you look at the market in general, let's say that they're waiting on a news report, they're waiting on some economic report, like a jobs report that comes out on every Thursday. There's the employment data comes out. And so you can see a lot of times before this economic data, you can see the market edging up before the announcement. And then it'll be a good announcement and it'll continue to go up. So you got to ask yourself, were people just guessing that it was going to be good news and buying early? Or are people taking advantage? Are there people who know obviously there's people who out there who have inside information. Are they profiting on that? And that's one thing that the Securities and Exchange Commission does, is they watch people's accounts and they try to see if they are using inside information. The inside information, so takeaway, the main conclusion here, the main takeaway, the semi-strong form, the markets are efficient in the semi-strong form. It's stating that all publicly available information is reflected in the market. Okay, the strong form deals with what I was just talking about, inside information. So the strong form is saying that all inside information is reflected in the market, and that the markets are efficient based on, in the strong form, the markets are efficient based on inside information. So there's basically what that's saying is that you can use that inside information, that you cannot use inside information um, to um, to make money in the market, that the markets are efficient in the strong form. That is not true. The markets are not efficient in the strong form, because if you have inside information, you can make a profit. Of course, if I have information that no one else has or very few other people have, say, like I was mentioning in chapter 1, I, um, I know that the FDA is going to approve a new drug on Monday. Today's Thursday. So I buy the stock and the drug gets approved on Monday, the stock goes way up. Well, the SEC is probably going to look at who profited from that, and they might flag my account because that's illegal. So it is illegal to use inside information, because the markets are not efficient in the strong form, and people can make abnormal returns using inside information. And so, you want the market, you want integrity in the market, you want people to believe in the market and to invest in the market. And if they didn't believe that the market was efficient, they wouldn't invest in it, the market would crash. And so that's why we have accounting firms that audit the financial statements. People have to be able to rely on the information that we're given. And that's why inside information is illegal, acting on inside information, because it gives someone an unfair advantage. Okay, so that's those are the 3 forms of market efficiency. So we've talked about market efficiency, we've talked about how the markets are efficient, but there are some anomalies that where it appears that you can make some abnormal profits. And so these are some of examples of anomalies. Most of them have not panned out. This one is buying low price to earnings stocks. Okay, so low PE stocks. All right, so this theory was, okay, if you remember this formula, the PE ratio is the price per share divided by earnings per share. Okay, so let's just say that, let's keep the earnings constant, because the earnings usually don't change that much. But let's look at the price. Let's say we had a really good company, but there was some bad news, there was some kind of legal problem, or they had some kind of an issue where the stock price just tumbled. So it's a good company. So in other words, if you know a company to be a good company, but the price has gone down for some reason, that's going to lower the PE ratio, because if the numerator is lower, that's going to lower your number, right? So the theory was, let's look at companies that have low PE ratios and invest in those companies, and they're undervalued and we can make money. Well, this hasn't proven to be true, because if you can find a company that's a good company that has a temporarily lower PE ratio, then it would work. But a lot of these companies, they have low PE ratios for a reason. The stock price has gone down for a reason. And so over time, this hasn't worked. Okay, this one is the small firm effect, basically saying that if you invest in small companies, you can make more money than the market in general. That has a small and some validity. It had some validity like in the 80s and 90s, but we're not really seeing it that much these days. So that's kind of iffy too. Neglected firm effect. Again, if you can find a firm that's it's a good company, but it's being badly run or poorly run, then you can capitalize and make money. That's true. Now this one is really interesting. This January effect actually has some teeth to it. This actually is true. More they found consistency with this. So the reason for the January effect, what they're saying is that the stock market typically goes up in January, and this is true. This is why. In December, a lot of people are selling stocks for the reason that I mentioned with the capital gains and the capital losses. They're selling their losers to get so that they can minimize their tax effect. So you have a lot of selling going on in January. Then they buy back you have a lot of selling going on in December. Then they buy back in January. That's one theory for this January effect. The other theory for the January effect is that at the beginning of the year, a lot of these big institutional investors, they're rearranging their portfolios and they're doing their buying, a lot of buying for the year. There's just a lot of buying going on. So a lot of people anticipate this January effect. So they start buying in late December, early January. So the January effect really isn't all through January. It's really like late December through like January 5th. Studies have shown that you could make money, abnormal returns being in the market at that time. So that's what we mean by the January effect. There's also the day of the week effect. And that is, I think, that's like, you can, I think it's Tuesday, Wednesday, and Thursday. You don't buy on Friday and Monday. But it's basically, they've tried to see if they've done research to see if certain days of the week typically are up more than others. Again, I wouldn't really advise trying to invest this way. Now there were some people who were looking at the end of the month effect, and this was really interesting. In other words, they would buy like on the 28th of the month, and then they would sell on the 1st of the next month. They did this throughout the year, and they actually beat the market. But who's really going to do that? I mean, over the long run, you want to be in a diversified portfolio, and you're buying and holding. I mean, it doesn't. I really wouldn't think that would be long term. But they did find some evidence to support that. Then let's see. This is the only other one I wanted to mention. This overreaction effect. So there was in the book. There's a graph, but just think about this. So typically let's say that a company has a good earnings report. And so you're listening to the earnings report. Let's say the stock is at $20. Okay, so the stock's trading at $20 a share. It has a good earnings report. And let's say that it should be valued now at $22. And so in theory, the stock should immediately go up to $22 because of the semi-strong form efficient market hypothesis. It would go up to the new value, whatever that would be, and then stay at $22 theoretically. Okay, so what I'm saying is the price should correct immediately to the next price that it should be based on its value, and then it should stay there. But a lot of times what happens is it goes way up. You have this overreaction. Let's say it goes from $20 to $25. Excuse me. And then it trends down to $22. So that's what they mean by the overreaction effect. So this is how you can make money on the overreaction effect. It's the opposite side. Let's say that a company has a bad earnings report, and let's say it's a $20 stock. It goes down to $15. And so you think the market has overreacted. It really shouldn't be that low. So if a stock has a bad earnings report and sells off as an overreaction, that's a good buying opportunity. And then, so maybe the price should really be $18. And so that's how you can try to beat the market, by profiting on this overreaction effect. So what some traders will do is I've read this rule before, they have a 3-day rule. So let's say a company has a bad earnings report or something bad happens, the stock goes down. They usually wait about 3 days for the dust to settle and then see what happens, because it could tend to drift lower. Of course, it could go higher, but it could also tend to drift lower. Because sometimes what happens is if a company has a bad earnings report, it sells off. And then after a few days, these analysts come out with new price targets, and the price targets might be lower, or they might downgrade it from a hold to a sell or from a buy to a hold, and the price could even go down further. But anyway, the overreaction effect is basically just saying, mainly dealing with bad news versus good news. If there's bad news and that people tend to overreact on the downside and the upside. So if it's downside overreaction, you can buy and make some money. If it's an upside overreaction, you could short it, I guess, and make money. Okay, those are the main ones that I wanted to talk about there. So, and there is some empirical evidence to some of these things, like the overreaction effect, um, the small firm effect, and the January effect, but it's not really enough to say, okay, I'm going to not buy and hold securities. I'm just going to try to. It's not enough to put all of your money towards one of these schemes. Plus, this is all past behavior, and this past behavior in no way predicts the future. So it's kind of interesting to read about, but I wouldn't look at it seriously. But with that being said, though, I always do try to be in the market in January. Like if I'm thinking of maybe, um, I would definitely be 100% in stocks in January, because typically after the summer, typically in the fall through December and January, the market is typically up, not all the time. So I usually try to be 100% in equities, because I do believe in the January effect. But I'm not going to sell everything at the end of January. I just make sure I'm 100% in stocks in January, and then maybe not be 100% the rest of the year, possibly. Okay. Anyway, those are the main points of this chapter. And the implications of efficient market hypothesis, of course, is that nobody can game the system, and that it's a level playing field. That we can compete against the big guys out there, which in reality, it's not exactly a level playing field. I mean, they do have some advantages. The people on these large investors, and that's part of this grassroots effort that's going on in Reddit right now. This summer of 2021, Reddit is that people are trying to. They don't think it's a level playing field, and they're trying to kind of screw over the large institutional investors. And a lot of the retail investors feel more empowered now, which we are more empowered now, because we have the tools. We have the with computers and with these new trading platforms like Robinhood and such, we can really make a dent in people that have been using insider trading and gaming the system, because it does exist out there, even though it's not supposed to. It's just there's too much, there's so much of it going on. Not everyone's caught by the SEC, but in a general sense, overall the markets are efficient, and you can make money in the market by investing in a diversified portfolio and just having a long-term time horizon. Okay, thanks for watching. And this was the chapter 4 synopsis.